Good evening, everyone. Welcome to our Oklahoma State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for taking time out of your busy schedules during the week to be able to get a chance to hang out with us, talk a little bit about home buying and kind of what it might look like for you as you take the journey towards home ownership, which, by the way, is probably going to be one of your largest financial decisions you decide to make. So, we want to be here as a resource to help you really understand what tools are available to you and support to help you in pursuit of this financial goal. Well, we're really proud to work in partnership with the Alumni Association on classes like this. We provide four of them over the course of the year. So once a quarter, we do our classes. I believe we have one more left on the calendar. And I'm proud to say we have some of your fellow alum that have purchased homes with us. In fact, I was meeting with one of your fellow alums just earlier today, purchasing a home out in the Tulsa market. And so really excited and grateful to be able to help support our local Oklahoma State community in home ownership. Now, American Pacific Mortgage is the ninth largest lender in the country, and our team in particular specializes in home buyer education. So we do classes like this. In fact, we'll teach over 10,000 future home buyers in home buying through our workshop platform that you guys are a part of this evening. Now, our classes are very interactive. So as we move through our content tonight, we encourage our class to answer or ask questions of us. And what we'll use those questions is kind of obviously to share back with the audience. So if you want to use the Q&A function in Zoom or in the chat, whatever works better for you, we'll make sure to get those questions answered on air. I know we had quite a few of you sign up for tonight's class, so we're really excited about the participation from our community. Now, I'm always curious as I get a chance to start these classes to learn a little bit more about where our audience is joining us from. So if you have a chance, just drop in the chat maybe where you're joining us from or maybe where you want to purchase, because we're going to talk a little bit about the housing market in just a bit. And it's always nice to kind of see where people are thinking about buying, because then we can provide a little bit of insight as to what we know about those markets. All right, so this is our plan for tonight. And by the way, we're recording tonight's class. Those that have signed up for tonight's class, we're going to share back all the slides from tonight's presentation, as well as the recorded video as well too. So we'll make sure that we get that out to you. Now, here's our talking points for this evening. We're going to talk a little bit about the housing market and kind of what's happening with the housing market, like I just mentioned. We also are going to also take a look at interest rates. I think that's top of mind for a lot of future home buyers, because there's a lot of talk in the headlines right now about interest rates. So I'm going to give you some insight as to where we're at today, where we think we're going from an interest rate perspective, and how you can plan for yourself really as you're considering home ownership. I'm also going to walk you through a home buying budgeting exercise, so we can kind of look at going down the path of renting and maybe continuing what we're doing today, or alternatively, what it could look like if I decide to purchase and consider home ownership. I also want to walk through credit and give you some tips and tricks around credit, maybe some low-hanging opportunities that you can focus in on as a buyer. Look at loan programs that are available to you. I always like to talk about savings plans in our classes to help really give you some ideas on how to get more resources for home ownership. But we will also talk about first-time home buyer programs that are available to you. I know just looking at the chat, many of you are in Oklahoma, so we can talk a little bit about Oklahoma first-time buyer programs. If you're thinking about buying somewhere else, there are first-time buyer programs that we support all across the country. And I also want to walk you through the workflow of buying a home. So after leaving tonight's class, you may be giving some consideration now to about home buying. Of course, we want to be your partner in that journey, but it's nice to know like what comes next after tonight's class. So I'm going to walk you through the buying process and where do we go from here after class, and kind of more information on how to schedule your free online consultation. All right, so that is our plan for tonight. Those of you that participated in our group activity, if you will, thank you so much for putting your information in the chat. So most of us are in Oklahoma, which is great because we're in the right place, because this is an Oklahoma-based class. But we can certainly talk about other markets if necessary. So let's go ahead and dive in and talk a little bit about, first of all, what does buying look like for me, and does it make sense, right? So home purchasing is probably going to be one of the number one financial decisions you decide to make. I know it's not the most exciting thing in the world to spend a Wednesday night talking about home buying, but clearly you guys understand the significance of this financial decision, because you're going to spend an hour with us on a Wednesday night. When we think about home buying, there's a lot of great benefits that we have to factor into our calculations of home buying, like the ability to be able to control more of our housing budget. So we're not worried about a landlord that might be increasing our rent as we renew our lease. So that's a big benefit of home buying. Now, some of our clients that are buying today, they are going to be buying in slightly higher than, not expected, but slightly higher interest rate levels than what we've seen on historical averages. But those buyers will have opportunities to refinance over time, and that's something that we look in our strategic plan as part of our aftercare for our clients. And this is an asset that should grow over time. So as that home goes up in value, as I pay down my principal balance, the difference between those numbers is called home equity. For most people across the country, that's their number one asset that really has the opportunity of creating generational wealth for families. And believe it or not, there's still some tax benefits that come along with owning a home, the potential tax deductibility of interest, as well as when you choose to make energy efficient upgrades to your home, you can also reap some tax benefits through that, those upgrades as well too. So those are all things that we encourage future buyers to put into the calculations in their considerations of home ownership, because it is truly an investment in your financial future. Now, to help you frame that up a little bit more, we always like to start our classes by going through what we call as a rent versus buying calculator, just to get a better assessment of budget in comparing my current path of renting or whatever our home ownership situation looks like versus what it could look like from a home buying perspective. So I have on screen one of our calculators. We would encourage you to do your own, kind of dive into this calculator. I wanted to walk our class through just an exercise of this so you can see how the functionality is on it. But ultimately, this is a great way of really better understanding the benefits that come along with home ownership. So here's what this calculator looks like. So we would first start by entering a projected sales price. So many of you in tonight's class have already started doing some home search online. We would want to plug in that sales price number. And then we're going to talk more about loan programs in tonight's session, but we're going to look at what a minimum down payment might be as a first-time buyer. So in this case, on a conventional loan, it's 3% of the purchase price. And then that would assume that we're going to finance 97% of this loan, of this purchase price. And then we have expected interest rates. We have the term of my loan, which we have a 30-year fixed mortgage in this case. And we have a situation where someone's assuming that they're going to buy in the month of August. And then we're going to talk more about private mortgage insurance, or PMI, later in our class. But when we put less than 20% down, we will have PMI. So we factor for that into our payment calculation. We also assume homeowners insurance rates. We look at taxes that we pay on our home. And for some of us that might be thinking about buying a condominium, maybe a townhouse, some type of community that might have homeowners association dues, we plug in a number there. This scenario doesn't have that. And we also have to take consideration into what it looks like from a tax perspective. So we have someone that's in the 25% tax bracket, the cost of maintaining my home, what that looks like if I decide to sell my home at some point in time. How much is it going to cost me with realtor fees? And then what is my home going to appreciate on an annual basis? And that obviously varies depending on what part of the country we're in and the cycles of the housing market that we see. And then we're going to take that as our home ownership column, if you will, and we're going to compare that to someone that's renting for $1,500 a month. That also assumes that person has renter's insurance and that their rent will go up by about 2% on an annualized basis. So what our calculator tells us, first of all, we got to look at what our break even looks like. So our calculator tells us that after 3 years, if I'm going to buy a $250,000 home and I'm currently renting for $1,500 a month in rent, it makes sense for me to consider buying after 3 years of ownership. Okay. Now, that becomes a profitable opportunity for me. Now, if I decide to spend, let's say, upwards of 10 years in this home, when I compare continuing to rent for 15 years or 10 years, I'm sorry, versus owning for 10 years, I have about a $76,000 buy opportunity versus renting. So you can see after 10 years, I've given about $200,000 in rent to my landlord, versus on the buy side, I've gotten through appreciation, through tax benefits, through payment principal reduction. I've achieved about $122,000 on the buy side. So, that does not we also got to take into consideration how much equity we're going to have in our home after 10 years. So, when we think about home ownership, I always challenge our classes, think a little bit beyond just the dollars and cents, comparing to where I'm currently at today versus where I want to be from a housing budget perspective, because we have to factor in all of the benefits that are part of potential home ownership. All right. Now, I would encourage our class, take some time to dive into that yourself. I think you'll find that to be a really enlightening exercise as you consider this kind of pursuit of home ownership. Now, another thing that obviously buyers are going to look at is what's the housing market doing right now. And we're still in the summer buying months right now. I know we only have a few days left in the summer season, but nonetheless, the markets are trying to find its way a little bit. In some markets across the country, we're seeing a lot more supply that's stacking up there. Texas, just one of our adjacent companies, adjacent states to Oklahoma, has one of the highest levels of inventory right now. Florida's another high inventory state. Colorado, Georgia, all of those states have much larger supplies, which is more favorable to buyers. Oklahoma's housing market is still a little bit favorable too, not to the extent of supply that we see in nearby Texas, but right now median days on market is 38 days. You can see the median sales price of home kind of flattening a little bit, maybe even almost argue you could go a little bit down. You can see the number of sales or homes sold year over year. And so, as we look at the market, supply has over the last 2 years been a challenge for us, but we are seeing a little bit more supply out there, not just in some of those other states that I mentioned, but I would argue that Oklahoma as well, because you're seeing homes stay on the market +7 year over year. And so that's an encouraging sign for buyers. And so as we have more supply, that creates a little bit more competition amongst sellers to potentially cut price or to contribute towards buyers' cost of purchasing a home. In fact, in 44% of all transactions being done across the country, they include some type of concession by the seller. And that also is an encouraging sign. You could make the argument that in some markets, we're actually in a buyer's market, which is a super encouraging sign. Especially, it's really a far cry from what we've seen in previous years' markets. Now, interest rate is also going to play a role in buyer activity, how much, or how much homes are selling for, how quickly those homes are selling. And so I want to give you kind of an insight into what interest rates are doing. We've had some encouraging news over the last probably 4 days, if we look back into last week, of kind of where we think interest rates were going. We are expecting the Federal Reserve to probably cut interest rates by 1/4% at next month's meeting. So that's an encouraging sign. We've already seen some of that already ripple into mortgage interest rates. So as you pay attention to the economic headlines and you see that the Federal Reserve is going to cut interest rates, that will have a direct correlation to what you pay in credit card rates, what you're getting in terms of yields and savings accounts, cost of personal loans, auto financing, and it also has a spillover effect into what mortgage rates do. But generally, the mortgage rate is the precursor to what rates are going to be doing with the Federal Reserve cut of rates. Now, here's what rates look like over the last 12 months. It's been quite a bumpy ride. You can see, looking in the news, the Federal Reserve is getting a lot of pressure here. But with what Federal Chairman Jerome Powell came out and said Friday was kind of more of a dovish look on the outlook of the economy. And so it gave way to that potentially they are going to cut those rates in September. Some folks that are kind of making projections on the market expect maybe there might be 3 rate cuts left in from the Federal Reserve this year. So obviously we'll be waiting for that really in anticipation. Now, beyond kind of the choppiness we've seen in the last 12 months of interest rates, some of the interest rate activity has put buyers on the sidelines. But as those rates go lower, more buyer activity will pick up. And so, that's something as a prospective buyer, we're really going to have to watch, because if more buyers enter the market, then more supply is going to be kind of grabbed up in the market, which could change prices. And so, it is, something to think through a little bit as potential buyers is, when do I want to enter the market? Because if I'm waiting for interest rates to fall, guess what? Other buyers are waiting for the same thing. You have more competition, could see elevation in prices in some markets. Now, over the last 20 years, this is a look at interest rates. Interest rates, 20 years ago looked very similar to where we're at today, but of course, home prices looked a lot different as well too. And you can see by these gray bars, these represent economic crises. So you can see the housing crash of 2008, 2009. You can see the pandemic of 2020. I always like to point in our classes that some clients are waiting for rates to go back to 2.5%, right? Well, the reality is the historical average is in the high 4s to low 5s, maybe 4.75 in interest rates. So not likely that we're ever going to return to 2.5% days. And, frankly, we hopefully will never do that, because then we have something globally in crisis, right? So, but I think as you think about the market, today's average interest rate, 6.6 to 6.5, Historical averages are in the high fours. So certainly we project to go lower over the next couple years, but we're not quite there yet, but certainly some encouraging signs in the interest rate market. Now, interest rates are not the same for all buyers. I think that's important to understand. They are based upon credit score and eligibility of a product, the program that I select, how much I finance, what my down payment looks like. We haven't talked about this yet, but this is called points, which is essentially paying additional funds out of pocket in order to bring down your interest rate. That is an option, but in today's market, I don't necessarily recommend buyers doing that because many of our clients purchasing in today's market are probably going to consider refinancing in a couple years. So it doesn't make sense to put all this money out of pocket to bring down my interest rate by 0.5% or 1%, whatever the number is, but then turn around and refinance in a couple years. Loan term can also reduce the cost of my interest rate. But for most first-time buyers, the standard program we're going to look at is a 30-year fixed, fully amortized loan. That means the interest rate is fixed for the full duration of 30 years with no changes in monthly payment. As we get a chance to meet with our clients for their own consultation, we're going to figure out what's the right product design for them, taking into consideration eligibility, resources that they have available to them, and certainly what the purchase price looks like for them in today's market. All right. Now, one of the bigger components to designing the right financing for clients is understanding credit. So in this part of class, we like to talk a little bit about credit, give you some resources, maybe some tips that you can take away from today's class to help maybe make some improvement on your own specific credit profile. Now, every loan program has a minimum credit score, and so we have those highlighted here. So that's kind of the minimum entry point for each product. Now, in credit scoring, there are 3 different models to credit reports. There's a credit card model, there's auto financing, and then there's a mortgage model for home financing. Now, of course, in our world, home financing, the mortgage model is what we look at. There are 3 different agencies also that have those different models. Now, that's Experian, Equifax, and TransUnion. In lending, we always take the middle score of all 3 agencies' reported scores. So if my highest score is 780, let's say my middle score is 760, and my lowest score is 720, we're going to take the 760 as a score for qualifying purposes. Now, if I have a partner that's going to join me on the application, and let's say my partner scores are 700, 680, and maybe 660 is the lowest score, the 680 is the lowest score that's going to be used for qualifying purposes. So that's what we'd use to establish what the qualifying looks like. So we always take the lowest middle score between both clients, okay? We're going to have conversations like that with our clients during our sessions just to figure out strategically, does it make sense maybe just to apply in one of our names or combined? We'll figure that out together. Now, when we have events on our credit report, things like maybe a delinquent credit card payment that's over 30 days delinquent, it's going to impact my score in the most recent 12 to 24 months from the date of the reporting. So if I had a late payment back in October of 24, I'm still inside that 12-month window. So it's probably going to impact my score a little bit more. But as I move further and further away from that date of late last payment, I should see some incremental lift in my credit score. Now, negative items, this is how long they will stay with you on your report. But the most recent 12 to 24 months is really the impact of the score. So this matrix kind of gives you a guideline of how long they'll retain on your credit report. But like I said, most recent 12 to 24 months is how we kind of see those impacting the score. Now, as I mentioned, there is different models to scoring. And so I thought it would be helpful in our class tonight to walk you through the mortgage score model, because oftentimes as I'm working with clients, they may be a little bit shocked, if you will, by looking at their mortgage score versus their monitoring score. So, Wells Fargo may say you're at a 770, but when I do the mortgage score, maybe it's 760 or 740. But the reason for that is because there's different risk factors that go into a credit card model, which what Wells Fargo uses versus what we use on the mortgage side of things. So I thought it might be helpful to share with you what those risk components look like. 15% is going to be how long have I had credit. So the more mature my credit file is, probably the more improved my score is going to be. So someone that's had credit for 6 months versus someone that's had credit for 6 years, the 6-year profile, all things being equal, is probably going to be a higher credit score customer than someone that's just established credit. Now, that also comes into the 20% factor, which is how much new credit am I trying to open? So if I have new accounts that I'm trying to get access to, if I have creditors that are making hard inquiries on my credit, that has a 20% play in my credit score. Now, one of our things that we do, which is a little bit unique in our process, we only start our credit process to evaluate options for our clients with a soft inquiry. And the reason why we choose to do that is a soft inquiry doesn't impact our client's credit score, but it does give us visibility to what their score is, what their payment history looks like, so we can take that credit and make sure that we're applying the proper program for their qualifying. Most lenders will do a hard inquiry right away, but I don't really believe in that because it doesn't work really well for our buyers, especially those that may be on a longer timeline for buying. Maybe I'm not looking to buy in the next 2 to 3 months. Maybe it's in the next 2 to 3 years. Well, a soft inquiry allows you to understand your options without having your score directly impacted. 30% is going to be how much do I owe as it relates to revolving credit card debt or revolving lines of credit. That's called credit utilization. From my perspective, that's probably the biggest area of opportunity for most clients that I work with across the country is maybe we've charged up a little bit of debt and that debt is rising to a level that's impacting my credit score. So the rule of thumb is I definitely want to have my credit card balances at least below 50% of the credit limit amounts, ideally below 10% of the credit limit amounts. So if I'm currently running, say, 70% utilization of credit, so that means I'm occupying 70% of my credit limits that are available to me, my first action item is to try to work to get those below 50% utilization. Once I've gotten there, let's work towards 30% utilization. Optimal level is 10% utilization of credit. Now, here's one of your kind of tips, if you will, for credit and how you manage credit card debt. If you take a look at one of your credit card statements, there's two important dates. One is the due date. The other is a billing cycle date. The billing cycle date is the date which the credit card issuer sends out all your activity to the agencies reporting, TransUnion, Experian, and Equifax. My tip for us tonight is that if you can try to pay off or pay down the credit card before the end of the billing cycle date, what you're going to do is you're going to get that balance paid down before the data reports out to the agencies, therefore reflecting a much lower balance, lower credit utilization, and lifting your credit score. Okay, so that's just a way of kind of tweaking a little bit how you or when you pay your bill versus paying on the due date. Try to pay for the end of the billing cycle date. And then the last component is payment history. That's essentially how I paid my bills. The more severe my delinquency is, bigger impact I'm going to have to my credit score. Again, especially in the most recent 12 to 24 months, late payments are rated as 30-day lates, and then we go to 60-day lates and then 90+ day delinquencies. Obviously, the more number of days late that I have, bigger impact I'm going to have to my score. All right, we're going to now transition from credit to student loans. Now, before I do that, I just want to take a quick pause for the audience. Any questions so far in some of the concepts or context that you've heard so far? Any questions I can help answer? Okay, I don't see anybody chatting away there, so I'm going to go ahead and keep it moving. Let's talk a little bit about student loans because that kind of dovetails off of credit reports. Now, student loans are starting to become active into repayment. Now, if you're in active repayment and let's say you're on an income-based repayment program, we can use income-based right away. So if I have $75,000 in student loan debt and my payment's $250 per month, I can use that $250 payment right away for qualifying. Now, many of our clients are still in forbearance or they're in deferment because let's say they're back in school working on their master's program. If that's the case and they're still trying to qualify for home financing, then on an FHA loan, we take 0.5% of the balances as the monthly payment, 1% if we're doing a Fannie Mae conventional loan to determine the monthly payment. So that same $75,000 in debt on an FHA loan would equate to a $375 payment. For a conventional loan, it'd be $750. And so those are conversations I'm going to have with the client as we understand their loan structure. But ultimately, I think it's important for you as a buyer, as you're preparing for home ownership, to understand how student loans can affect you. So even though you may have a zero payment showing on your credit report, as a lender, we still have to evaluate what the actual payment's going to be for those outstanding balances. We did have a question come in the chat, which is, can you, so that was a thank you. Sorry, that was a question about explaining soft inquiries. So I'm glad you like that explanation. So, all right, thank you for commenting there. Let's talk a little bit about loan programs. And the reason why, we bring up student loans, for example, is because every loan program has guidelines that are associated with that. And one of the guidelines in conventional and FHA loans and other products is evaluating student loans and the repayment schedule for a buyer. So let's talk a little bit about each one of like these products, but from a high level perspective. As we get a chance to meet with you to build your home buying plan, we'll figure out which product connects best with you given your qualifying. The first product is a conventional loan. That conventional loan, when you think about that, the terminology that's probably more familiar with you is a Fannie Mae or Freddie Mac loan. That has a minimum down payment of 3% with a minimum score of 620. And across the country, each year we set a conforming loan limit that's done by FHFA, which is a federal housing agency. That conforming limit is 806,500 for all parts of the country. Now, certain high cost of living areas, which nobody in today's class is a part of, some of those more expensive areas in the country, but you can go to higher loan limits for some of those markets. The FHA loan has a minimum down payment of 3.5%, minimum score of 580. The loan amount will change by county on those on that product. This is a government insured loan. FHA stands for the Federal Housing Administration. And I thought I would kind of tie together, because these are both government insured loans, both the FHA loan and the USDA loan. USDA stands for the United States Department of Agriculture. In fact, a lot of our clients in the Oklahoma markets do look at USDA as an option because a lot of markets are considered rural by USDA's definitions. There are two qualifiers to USDA. It has to be considered rural from USDA. And we also look at the income by household to qualify for the product. And then the benefit is it has a zero down payment option, still has a little lower credit score requirement. And then the maximum loan amount does vary by the county that you want to buy in. Both of these products are government insured loans, and there were some changes to eligibility requirements just a couple months back, which indicates that to be able to have access to those programs, you do have to be a permanent resident of the United States to be able to access those funds. So unfortunately, those changes were made where you do have to be a permanent resident. Now, you can be a non-resident and still have access to Fannie Mae and Freddie Mac's product line, but it has changed for both of these government insured products. The jumbo loan is going to be for clients that need a little bit more funding power than what we can do with a conventional product, but it does come with it higher down payment requirements and higher credit score requirements. Last product I want to spotlight is our VA home loan. So our veterans that have eligibility under the VA home loan product does have a minimum credit score of 620. There's really no maximum loan amount, a little bit more flexibility for the veterans as it relates to expenses to income. Just a lot more flexibility to encourage home ownership for our veterans. Some veterans that have a partial disability from the VA will also be exempt from what we call is the VA funding fee. All right. So that's just like a high level look at loan programs. Now I want to dive a little bit deeper into both the conventional loan and the FHA loan from a mortgage insurance perspective. So we get a lot of talk from our communities that we serve on what mortgage insurance is, how does it work, what are the components to it. So let me kind of explain to you what PMI and upfront or MIP looks like on a government insured loan. So PMI stands for private mortgage insurance, and then MIP stands for mortgage insurance premium. Both are insurances that essentially cover the lender against default by the buyer. So if something was to go economic hardship by the buyer, couldn't afford their home, the lender would be protected by one of these mortgage insurance premium policies. Now, when we think about PMI for a conventional loan, it is based upon down payment, credit score, and then how much you finance. And one of the benefits of a conventional PMI policy is that once you reach 2 years in your home and you have 22% equity, you can apply to have the mortgage insurance canceled. And because it is tiered by how much you have with down payment and score and amount finance, the PMI is not super expensive, especially as it relates to maybe the FHA product. So let's say, for example, I was financing $250,000 on a conventional loan and I was putting 3% down with a credit score of 740. My PMI is probably going to be about $85 a month. Now, if I can afford to put more money down or I can lift my credit score higher with some of our tips from tonight's class, then that mortgage insurance might be even cheaper. All right. So that's one side of it, which would be conventional PMI. The other side of it is on the FHA government insured loan, the MIP side. Now, there are two components to mortgage insurance for an FHA loan. There's monthly mortgage insurance, which is 0.55% of the loan amount. And then we divide that by 12 to figure out a dollar figure. And then there's upfront mortgage insurance, which is 1.75% of my total loan amount. Now, with the upfront mortgage insurance, it is a one-time fee, but it gets added into the total balance that you're financing with your home purchase. Now, with FHA loans, unfortunately, there is no cancellation option. So even though I have maybe appreciation in my home or I've had my loan for 2 years, like the conventional loan, the only way to cancel mortgage insurance on FHA is if I refinance out of the FHA loan into more of a conventional home loan product. Now, here's a similar example of payment shown here. So we finance the 250 amount for FHA. We have our upfront mortgage insurance that gets added into the amount financed. And then there's the monthly MIP, which is, about $21 higher per month as opposed to the conventional product. Now, all that being said, we can clearly see the expense difference between the two products. But as we learned a little bit earlier in our products segment, each loan program has different minimum credit score requirements. Also, there's different underwriting guidelines for each product. So our clients may not have eligibility in a conventional product, and FHA offers an alternative to those that can't qualify in a conventional loan or maybe any other product. So while the expenses might look a little bit different, we're trying to provide more resources to support you in home ownership. So, it's just important for you to understand the different characteristics that go into things like mortgage insurance when it comes to your home financing. Now, as we design home buying plans for our clients, we also have to take a look at employment and income that's generated, because ultimately, as your lender, we're figuring out how much income is generated versus what are the expenses going to look like. And we're going to walk you through an exercise in just a bit about debt to income ratio, which essentially is looking at those expenses versus income. Before we go through that exercise, I thought I would pass along to you some of the general documentation requirements. So if you're thinking about working with us to build your home buying plan, these are some of the documents that you would generally start to gather and provide to us through our upload process. And we'll talk more about that later. But into this segment, I do want to talk a little bit about employment, because we get a lot of questions around eligible income sources. So I want to kind of just walk through some different examples to help you understand a little bit more about how we evaluate income. So there is a 2-year rule in place that we essentially have to verify the last 2 years of income through employment or through education. So we can combine both timelines. So if I, graduated about a year ago from Oklahoma State and now I'm new in my career, and let's say I only have, 6 months in my job or whatever the case may be, as long as I can put together my education and or my work history for the last 2 years, that would fulfill the 2-year history requirement that's needed in financing. Now, if I'm self-employed, I do have to show that I've been filing taxes as self-employed for 2 years in order to count my self-employed income. So that's a little bit of a different rule. And if I have additional sources of income, let's say I work for 2 different employers, but I want to count both sources of income, then I do have to show that I've been with both employers simultaneously for the last 2 years. Some of our clients do have maybe a fixed income, maybe it's like a base salary, but then they also receive commissions or maybe bonuses. So they have incentive plans that tied to their position. In that case, I do have to show that I've been working for my employer simultaneously for 2 years in order to count those sources of income. Okay, because what we do is when we look at that income source, there can be variability to it. So we average it over 24 months to determine kind of the consistency of the earnings. All right. And then things like overtime income, which some of our clients that are on hourly schedules get, those are also scenarios where we take a look at them and average them over a 2-year history time period. All right. And then, another thing that kind of comes up a little bit is looking at situations where I have maybe a prospective job offer. In fact, I had a conversation with a client today that's working for a local school district, but has a new job opportunity starting in October 1st. Well, in lending, as long as I can get an offer letter or job transfer letter indicating what my new salary is going to be and making sure it's fully executed and when I'm going to start that position, we can use that income right away without having to wait for that client to work in that position for 2 years. All right. So those are things that kind of come up in the conversations with clients. Also, one other thing I think I would add on to the group discussion is that when we look at other sources, like let's say my partner contributes to the household, but my partner's choosing not to be on the application for the financing, I can't count those sources of income unless they're going to be a part of the application. So we get that come up quite a bit in our conversations with clients. All right. That gives you a little bit of idea of income. Now, we also, like I mentioned earlier, talk with our clients or evaluate expenses versus income in determining home buying plans for our clients. We call that calculation debt to income ratio. And so essentially we're looking at is how much of my pre-tax income is being consumed by my expenses in my household. Those are existing expenses like maybe student loans or car payments or credit cards, but also my projected housing payment, which you can see on screen here. So we're going to factor in the principal and interest of my loan, the property taxes, maybe the homeowner's insurance. If I'm paying private mortgage insurance, we'll factor that into the calculation. Maybe I'm considering buying a condominium or a townhouse. I might have to factor this into the budget, HOA fees. And so ultimately, when we think about this calculation, we don't want, at worst case scenario, to have a client's expenses reach more than 45 to 50% of that pre-tax income. Now, ideally, we're going to be at 36% or less. I would consider that more the comfort zone or optimal level for buyers. But at times, some clients have to stretch a little bit beyond that, especially in a high inflationary environment that we're in today. So we understand that, but the guidelines allow us to go up to 45 to 50%. Comfort zone is probably less than 36%. Here's what a calculation looks like for an example of a client. So, we have our acronym here of principal and interest, taxes, insurance, PMI, private mortgage insurance. There's an HOA. So if we had a scenario where someone's paying, let's say $2,000 a month in housing expense, they have $500 in other debts, and they're making $8,000 in pre-tax income, that would indicate to us that that client has a 31.25% debt to income ratio. That would be well within the guidelines, certainly a very affordable level when it comes to qualifying. Now, that isn't just the be all end all when it comes to figuring out budgets for clients. As we have conversations with you around affordability, which is honestly more important, we're going to figure out what that right housing expense needs to look like for you. So if I'm going to transition from $1,500 in renting right now and I'm jumping up to $2,500 in ownership payments, we want to make sure that's going to be sustainable for you, because that's really an important part of building a successful home buying plan for our clients. Now, the last component to home ownership is savings for home ownership. And quite honestly, for our class, that's probably the most difficult part of home ownership, is how do I save enough to reach my goals of home ownership? Now, we're going to talk about assistance programs in just a bit, but I thought I would share with class some of the documentation that we'll generally need to validate assets. And then I want to give you a quick little example of a savings plan to help build your kind of resources for you in home ownership. So when we verify assets, we can use cash accounts like checking and savings accounts. We can't use cash per se, because everything has to be paper trailed. We have to source all assets being used in the last 60 days. Retirement accounts can be used. Investment accounts can also be used. I will always encourage clients, talk to your financial or tax professional before you access those assets, because we want to make sure that's a good financial move for you. Gift funds can also be allowed in home financing. There is no seasoning requirement for gift funds. A family member can transfer those funds right away as long as they're from an institution that we can document the availability of those funds. And we also have the donor provide a gift letter that's signed indicating no repayment is required on those gift funds. All right. So that gives you an idea of some of the documents that are generally required to validate assets. But let's talk now about savings plans for home ownership. And again, that's a bigger challenge for most of our clients, especially in today's housing market. How do we get enough money put together if we don't have the resources in a brokerage account or gift funds from family? So here's a really simple approach to savings, and it looks like this. So if I'm in a housing situation where, let's say I'm paying $1,500 a month in rent, and I feel pretty good about that, but really home ownership is a huge goal for me and I want to get there, but I just don't have the savings today. I know I can afford that $3,000 projected mortgage payment here, but I'm not there from a savings perspective. So what I would encourage our client to do is, let's today, on the first of the month, when I make that rent payment, so on September 1st, when I make that $1,500 rent payment, also add an additional $1,500 that gets transferred right to your savings account on a monthly basis. And what it does is, obviously is going to accrue larger savings. So at the end of 6 months, I have $9,000 accrued in my account. End of a year, I have $18,000. But it also creates that discipline of me making that payment at $3,000 a month in rent, or in mortgage, I should say. So when I transition from renting to owning, it's not such a big jump, right? Because I've been doing it for the last 6 to 12 months. And by the way, along the way, I've also built that nest egg of resources towards my home ownership goals. Okay. So I know that's kind of in the perfect world, but that is a really simple approach to savings for home ownership, but effective. And we have countless clients that have really kind of taken that on and really helped them achieve really a great resources or source of funds for them as they're pursuing homeownership. Now, assistance programs can also make homeownership really more of a near-term goal for you. In the state of Oklahoma, like other states, there's what we call an HFA, or Housing Finance Agency. So the state of Oklahoma has a program through the HFA that provides up to 3.5% in assistance funds. Those can be used towards down payment or closing costs. It is essentially a low interest rate loan assistance program that's provided to you, and it's not required to be paid back until you either sell the home or if you refinance in the future. Now, if you're a first responder, a teacher, or you're a state employee, there's also additional incentives provided to you through the Oklahoma HFA program. So, if you're thinking about buying in Oklahoma and you're certainly eligible, we definitely want to explore those options because those can really help to bring down your out-of-pocket expense in home ownership. Now, we also have nationally branded programs through APM, like the Pathway program, provides anywhere between 3.5% to 5% of our sales price and assistance funds. I will say the Oklahoma HFA programs, they will have income limits attached to them. So they'll be a bit restrictive based upon the median income of the market that you're going to buy in. Most first-time buyer programs will allow us to lend to buyers that are in 80% to 120% of the median income for that respective market they're going to buy in. The Pathway program does not have an income limit. So that's one of the kind of the appealing draws with that particular program. There's also some grants for first-time buyers that are considered very low-income buyers through Fannie Mae and Freddie Mac. So we can certainly explore those for you as we design your own home buying plan. It's important for you, obviously, to understand your options in home ownership, and having the access to first-time buyer programs is really important because not all lenders are set up with first-time buyer programs, but that is one of the things that we really value within APM, that we want to make sure that you have all the resources available to you to make home ownership really affordable for you. Now, as we're getting towards the latter part of tonight's class, I want to now walk us through the buying process, the workflow of buying. So many of our attendees to our classes ask us, what do we do next after this? We enjoyed the class. We got some really good ideas. How do we start our path towards home ownership? So I want to walk you through the workflow of buying and take you through these different milestones. This is our 6 steps of home buying. So step 1 is really the next step after tonight's class, which is we would love to connect with you for a free consultation. Now, that consultation allows us to meet with you virtually for 30 minutes to design a home buying plan. And we get a chance to do that all throughout our day. We build the framework of financing. We understand your options, your budget, assistance programs that can work for you. And then after we conclude that meeting, we now have a roadmap to home ownership, and we can then provide you a pre-approval that essentially allows you to start the home search. And that home search can be the longest phase of the process, whereas you're going to partner with a realtor, whether that's someone that you have that you trust in your local community, or you can take advantage of our preferred realtor network. We have agents that we trust in the process. We'll certainly make an introduction after your pre-approval. But the house hunting then begins after you're pre-approved. It can start online. It'll generally then move to in-person, and you'll start kind of identifying properties on your list that work for you. Now, once you've kind of targeted that home that you love, and let's say you want to make an offer on that home, then you would work with your realtor to design an offer letter a purchase offer to that selling agent that represents the seller of that home. Now, it may take a couple different offers to get the right home under contract, but once that offer is accepted by a seller, then you move to step 3, and that's called entering escrow in most parts of the country, or opening title. But ultimately, that means is a buyer and seller has come together with an agreement on terms of a contract, and now sets the stage for what's to come next in financing and other components of the home purchase. Now, generally from step 3, which is the accepted offer, to step 6, which is getting my keys, it's about a 30-day process in most parts of the country. It can be longer. Some of our transactions in Oklahoma are a little bit longer just by the negotiations with the seller. Maybe the seller needs a little bit longer to stay in the home. In fact, we have someone right now that's in escrow as part of the Alumni Association, and I think they have like a 40-day escrow. So it really just depends on the negotiations with the seller. But the traditional time period is usually about 30 days in most parts of the country. Now, once you have an accepted offer, you're going to get a call from our team saying, hey, congratulations. You'll get a call from me saying, hey, you did it. You have an accepted offer. Now let's talk a little bit about what to expect over the next 24 to 72 hours. Things like you're going to make an earnest money deposit, which is a deposit that goes towards your total out of pocket. You also meet with us for a follow-up video consultation. That's where you and I go through the design work of your financing. We take a lot of the ingredients that we use from the pre-approval stage at step one, then we build that into more real-time numbers that are part of your contract, essentially, that you've negotiated with your seller. And it really kind of puts everything in motion at step three. Now, this is a slide that kind of shows you what an earnest money deposit looks like. In most parts of the country, that deposit, by the way, that counts towards your total out-of-pocket, it's usually about 1 to 2% of your total sales price, okay? Now, that deposit does count towards the out-of-pocket, but it also is protected within a contingency period that's in the contract. That contingency says that you have certain action items on your side as a buyer to complete before moving to the next milestone. For example, there's an appraisal contingency to ensure the house is worth what you're buying it for. We want to make sure your house gets inspected and you feel satisfied with the outcome of those inspections. And of course, we want to make sure that your financing gets approved. All of that's happening over the course of the process. Now, as we move through these milestones, step 4 is the processing and the underwriting of the loan. That's kind of more of the administrative functions of the financing. We're going to verify your employment, assets, making sure your program is structured correctly. And then we'll move everything into an underwriting system to have an underwriter review everything to make sure everything meets the approval expectations. Now, one of the things I like to share with our clients is that as we move through this kind of 30-day window of time with the escrow time period, we are going to strategically work with you on the timing of locking your interest rate in, because interest rates change throughout the trading day in the business day, right? Now, once you're under contract with the seller, then we can start thinking about locking in the interest rate. But there is strategy to that based upon what economic news is forthcoming, or things that we're trying to kind of like factor into the equation. So it's not essentially that we're going to lock in your rate at day one, because we want to have a conversation with you about how do we time the market to get you the most affordable financing options. As we move along, step 5 is going to be loan approval. So that means the underwriter has signed off on your loan. Your loan is approved. That also kind of moves us to closer to the end of your contingency period. By that time, we also have your appraisal back. And when you're at that contingency period, then you can communicate with your realtor that you have your loan approval, you have your appraisal completed, and then you should be able to sign off on your contingencies, which tells the seller that you're ready to move to the final stages. Before we do that, we do deliver to you a final closing disclosure that gives you a 3-day cooling off period before getting to the final milestone of closing your loan. Now, as you also move through these different milestones, we're going to be sending electronic disclosures to you, highlighting all of your information on your financing. So there really is no surprises. You understand exactly what your payment is, interest rate, out of pocket, of course, the program that you're selecting. That all comes out of our follow-up consultation that we do with you within a couple of days of your accepted offer. All right. Last stage in the process, which is really the finish line, that is the closing of the loan. That is the day that you'll be signing final loan documents in person with the title or escrow company, maybe even an attorney, depending on your transaction or what state you're buying in. That same day, you'll also wire in your final funds that are owed to facilitate or fulfill your transaction. As your lender, we do the same thing with your loan funds in any first-time buyer programs that you're going to do. Those funds get reconciled by the escrow team, and then they record documents with the local county recorder's office. They record a grant deed to transfer ownership to you, as well as the deed for the loan. Once all that is confirmed, is transferred and recorded, then we get a chance to make our favorite call of the day, which is to say, hey, congratulations, you did it. You're now a new homeowner. Time to work with your realtor to get your keys and start moving. And that's a huge day of celebration. It's a huge financial milestone and accomplishment. And of course, we want to be there to celebrate with you on that day. Now, our relationships with our clients don't stop there. Part of our aftercare is we're always staying connected with our clients. You heard me talk about refinancing earlier in today's class. So as rates start to trend lower and it makes sense for our clients to refinance, we're going to have our rate watch system to notify you when the right time is to refinance, and our HomeBot system that gives you calculators to accelerate your principal payment on your loan, to see what equity position looks like in your home. A lot of great tools to help you as homeowners. And of course, we're always checking in with our clients annually just to see what's happening, because let's face it, things change for ourselves always financially all the time, right? So we want to make sure that you understand what resources are available to you as a client with us. It's not a transaction for us. It truly is a relationship over time for our clients. Now, as we're wrapping up class, I just want to let you know how you can get started in the process If you're interested in learning more about your options in home buying, I just wanted to pass along our Get Started information. We have a really simple online application you can complete. We only start with a soft credit check, which doesn't impact your score. You can upload documents, and then you use our really easy scheduling system to schedule a virtual consultation with us. And that's a consultation I do personally with every client that attends our classes, just to make sure that I provide you with the right home buying plan for home ownership. We understand how massive of a financial decision this is. So we want to take the care and time to make sure that we understand how to build your financing and prepare you properly for home ownership. That's really a big difference in what we do versus maybe what some other lenders do. We understand the importance of really designing a sound financial decision for your financial plan. Here's what that service looks like for you. It is a free service, so there's no expectations other than make sure that we equip you with your options in home ownership, and of course, hopefully, you'll select us as your lender once you decide to purchase a home. But that's what a consultation service looks like for you. Now, we understand in our process that we have to leverage technology, and we do that through our mobile tools, through the APM mobile app. We also embrace AI, so we try to have real-time response times for our clients, but doesn't replace the human touch. Text messages, emails, calls. We want to make sure we're accessible for our clients because we understand how big of a decision this is for you. So we're always available to help answer our questions for our clients. Well, last thing I want to point out to you is not only do we have our classes that are free to our Oklahoma State community, but we also discount our services as an added incentive for you. So we actually provide a $750 discount in your closing cost structure, regardless of what type of loan program you use. And if you really enjoyed tonight's class, I hope you did. We would encourage you to share this, class schedule with friends, family, coworkers. We also have 15 other partnerships across the country that support our local communities in homebuyer education. So, if you think someone that might enjoy this class, feel free to pass along our information to them. We'd love to have them at one of our upcoming classes. We still have a full slate of classes left for the next, 4 months we have in 2025, and we'll have a fresh new schedule events for 2026. Here's my contact information. So if you like to just reach out to me after tonight's class, feel free to do so. I've also provided our scheduling link here. So if you do want to book a call time with me or schedule your consultation to build your home buying plan, love to be there as a resource for you as well. And last thing I just want to point out to you, you heard me that I'll definitely have the recorded version of the class up on our YouTube channel tomorrow. I'd also encourage you to explore and research some of our social channels, provide a lot of great information there, but we're also most proud about what our clients say about us in our communities through our partnerships across the country, about how we supported them in their largest decision. We just had one of your fellow alum buy a home last month in Stillwater. Really was proud to help support them on their journey towards homeownership and their relocation to Stillwater. And hopefully some of you in class will be the next to take that next steps in homeownership. So with that said, we got a few minutes left in our class schedule. I will stay as late as you guys need me to, but I just want to make sure that I can answer any questions for our class, and be a resource here for you. So feel free to drop any questions you do have in Q&A or chat, and I'm more than happy to answer those before we wrap up class today. Anyone out there? All right, so we do have a question that was on USDA. I probably should have hit on this a little bit more, but USDA, the question is USDA zero down, but can you still put less than 10% or something like that? So yeah, so the draw with USDA, it is a zero down payment option, but you have flexibility to add as much as you want. So you could, to your point, you could add 10% down if you wanted to. So yeah, it is a zero down payment option. With USDA, there's two expense factors to it. They're a little bit different than mortgage insurance that we talked about earlier. There's what they call a USDA guarantee fee. There's a 1% guarantee fee that goes on top of the loan amount. And instead of paying mortgage insurance, you pay a monthly guarantee fee, which is 0.35% of the loan amount. And then we divide that by 12 to figure out what the monthly cash expenses. All right. Thank you for that. Also, some first-time buyer programs will work with the USDA product as well, too. And question in the chat was, will we get a link of the recording to reference back this presentation? Yes, you will. So we had quite a few folks that signed up for tonight's class, so they will get the recorded version of this. Everybody, as long as we have your email list or email on our list, then we'll also share with you the slides from the night as well too. And you can also find it on YouTube channel. You can also see some of the past Oklahoma State classes up on our YouTube channel as well too. All right, thank you for that. All right, anything else from our group? I do appreciate everybody sticking around for most of the entire class. If you join late too, like we said, with the classes recorded, so you can look back on our YouTube channel and pick up any of the segments that you missed. All right. Okay. Well, thank you so much. I know I probably took up some time in dinner for most of you guys in the central time zone. Thank you so much for being a part of tonight's class. Hopefully you had a few takeaways, and I look forward to hopefully seeing you soon at a future consultation. Have a good night.